Welcome to Elliott Wave International's e-learning series for traders. This course is entitled The Basics of the Wave Principle. My name is Wayne Gorman, and I will be your instructor throughout this course. I'll first talk about Ralph Nelson Elliott and his discovery, the wave principle. I'll then cover motive waves, corrective waves, rules, guidelines, wave personalities, Fibonacci relationships, and then we'll have a summary at the end of the key points of the course. These sections are all numbered to make it easy for you to navigate from one section to the next. You also have a control bar at the bottom left corner that makes it easy to navigate within sections. So let's start with the introduction. Our research shows that in financial markets, investors have an unconscious impulse to herd. That is, they follow the actions of others, whether those others are on the right side of the market or not. They make subjective, impulsive decisions under conditions of uncertainty, and the resulting prices or values do not revert to a particular mean or equilibrium. The prices are in fact following a pattern. The wave principle states that financial markets are pattern, and it is that pattern that we are going to analyze in this course. But before we get into the pattern, I'd like to just talk a little bit about the person who discovered the wave principle, Ralph Nelson Elliott. Ralph Nelson Elliott, an accountant by trade, analyzed the stock market in the early 1930s. He discovered that crowd behavior moves up and down in certain recognizable patterns that he referred to as waves. These wave structures link together to form larger versions of the same patterns, and in turn become the building blocks for patterns of next larger sizes, and so on. He coined this phenomenon the wave principle. And in his book, Nature's Law, The Secret of the Universe, he explained his observations. So let's look at the basic pattern of Elliott's discovery of the wave principle. It consists of a structure, as you see here, of 5 waves up, numbered 1 through 5. And the way to look at this chart is to imagine time going horizontally on the x-axis and price on the y-axis. So these lines are actually representing prices, or a plot of price points over time in a financial market. And the time frame could be a day, a year, a week. In either case, the structure is similar, and we're going to get into that in a few minutes. After a 5-wave sequence has been completed, there is a corrective phase, and we use letters A, B, and C to label the 3 waves of the correction. If you look on the left side of this diagram, you see that I've labeled the first 5-wave advance the motive phase. The motive phase consists of 5 waves up going in the direction of the main trend. Waves 1, 3, and 5 are called actionary waves. They're moving in the direction of the main trend of one larger degree, and I'll explain that term degree on the next slide. Waves 2 and 4 are called corrective waves. They interrupt the main trend. Each of these waves can further subdivide into other waves. And let me show you what I mean by that. On this diagram, I've divided each of the actionary waves 1, 3, and 5 further down into 5 waves, and waves 2 and 4 into 3 waves. I've also subdivided waves A, B, and C into further wave structures. So, for example, this whole time period might be 1 year, but the other wave structures within each wave may be several weeks or several days. We refer to each of the time frames as degrees. And if I carry it a step further, you can see I now have also subdivided further each of the waves into their components. Waves 1, 3, and 5 further subdivide into 5 waves, waves 2 and 4 into 3 waves. In order to communicate our analysis, we assign labels to these various time frames or degrees. Here's a chart that shows the different types of degrees. The highlighted area indicates various degrees or time frames that we're analyzing markets most of the time: cycle, primary, intermediate, minor, and minute. Here's a more realistic diagram of what the stock market would look like, showing the wave structure. We have 5 waves up, waves 1, 2, 3, 4, and 5. And each of the actionary waves, waves 1, 3, and 5, further subdivide into 5 waves. And each of the actionary waves within that structure also subdivide into 5. Waves 2 and 4 subdivide into 3. We refer to this characteristic of similar structure at different time frames as self-similarity. That is, the structures are similar but not exact at each time frame. And we have a name to characterize that feature. We call that a robust fractal. A robust fractal is any structure that is similar at different time frames but not exact. Let me show you a real example of that on the next slide. This is the Dow Jones Industrial Average at various time frames, starting with chart 1. It's a second by second chart of the Dow, and then going across to chart 2, which is hourly, and then daily, weekly, monthly, and yearly. We also see the wave labels on each chart, labeling the motive phase going up in waves 1 through 5 and the corrective phase labeled A, B, and C. Notice how in charts 1 through 5, although they are vastly different time frames, the structures are similar: 5 waves up, 3 waves down. In chart number 6, the structure is 5 waves up and is similar to the first phase of charts 1 through 5. But since it has not completed its cycle, you don't see the ABC corrective phase. If I carry it a step further, with chart number 7, comparing to charts 5 and 6, chart number 7 is a decade-by-decade chart of the stock market, and you can see it has a similar structure of 5 waves up, similar to chart 6 and the first phase of chart 5. Therefore, we say that the stock market and other financial markets are robust fractals. They are similar in structure at each time frame, or what we call degree. The wave principle states that mankind's progress, usually measured by the stock market valuation, is not a straight line, random, or cyclical. It is patterned. Growth and thereby social systems are moving in a pattern consisting of 5 waves up and 3 waves down. This pattern reflects the alternation of growth and non-growth or decline. Why is the wave principle so important? 3 key reasons. First, it helps us to predict market direction. Second, we can identify turning points in markets. And lastly, it provides guidance for entering and exiting positions, whether they be trading positions or investment positions.